Good day, traders. Stacey Burke from Stacey Burke Trading, and today we're going to talk about daily charts and fractals and taking the complex and making it simple. I'm going to try and do this as a short video, but you can use this to go and do your own research. Big picture, narrowing everything down to setups, and again, just taking the complex and making it simple. There's going to be a lot of things that I'll go over here that will be traders will be very familiar with, and I've spoken to some very highly mathematically skilled traders, and the fractal portion of this, again, we'll talk about that, but there's some very, very well-educated individuals who are already pursuing that style of trading. And just coming back to what I look for, which again, I have leapfrogged some concepts, and in the last few videos I've tried to go back and big picture things, the matrix, we've talked about the box, classical charting patterns, and just coming back to the start of the week, the start of the month, the big picture daily charts. Now, the first thing I want to talk about is that everything is fractal, and obviously many traders are aware of that, but the reality of it is that trading, the most important part about trading as a retail trader are that if it's not simple, you can't duplicate it on a regular basis. So, again, this next sentence underneath or paragraph underneath, the golden ratio, pi, fibs, Gann, Elliott wave, they're all very, very accurate methods of trading the markets. But the reality of it is, for the average retail trader or any trader, the duplication of any of those from trader to trader is inconsistent. So you could have the exact same strategy, again, trading Elliott wave. Very rarely do you get two Elliott wave people agreeing on the same, wave counts, or people agreeing on where a fib level should be placed, or I've talked to traders that everything's based on pi expansions, and they're all accurate. They're all accurate. Fibonacci's. I've talked about McLaren and just using quarters and 100% expansions of ranges, because for me that's simple. And again, I keep coming back. We're going to talk about fractals in a second, but just understanding, taking the big picture down and scaling everything right down to setups from the big picture in terms of setups that I can duplicate my process and my approach to the market every single day on the setups that have edge. That is the most important and only thing for me. So all of the big picture stuff is extremely relevant, but only if it translates into a duplicatable process that's simple for me to do day in and day out, that actually has edge. For those of you that aren't familiar with fractals, you can go and read about fractals. It's really quite amazing, all the interesting things in nature and in markets that are fractal. From a scientific or mathematical standpoint, there are several interesting components of fractals. But what's most important is that when you understand the fractal nature of markets, is that the movement itself may appear diverse and noisy, but it is not random, because there's a relationship between the short-term and the long-term fluctuations. There will be many small changes, and their accumulation will be followed by an occasional big change, which in turn will either shift the system to a new state or bring it back to the low amplitude fluctuation mode. So I have talked about the three things that markets do. They trend, they reverse, trade, breakout and trend, breakout and reverse, or go back and forth in a trading range. Now, those are all fractal movements on the smallest level. And again, taking the complex down to simple setups that involve time and price. We have levels based on those fractal movements. We have average monthly ranges. We have average weekly ranges. And we have average daily ranges. The timing of these moves can coincide and extrapolate out to any time frame we want. But coming back to some simple models, the first thing I look at is the daily chart. Now, we can use any instrument, but again, I'll just, in the shortness of time, I will recommend that you go and apply this on any instrument that you're trading. But for end-of-day traders, this will be a powerful, hopefully, educational insight into some trading strategies for you as well. But the same process applies on the monthly timing frame. The new month kicks in, there's a high and a low of the month. And again, I talk about everything being in a box. And when the new month starts, this can help us to develop a thesis of markets that are either trading outside of their box, breaking out, pulling back, reversing, and continuing at a new monthly cycle. And again, we will break this down into smaller cycles. So we can talk about monthly, weekly, daily, and session cycles. Just highlight that. And then the consolidations around major round numbers and quarter levels. So not only can we coincide major round numbers, we can see 115, then our timing of a new month. The market trades halfway of that 500 pip box, breaking through major double zeros at 110 in the new month, a breakout. And again, pulling back, one push, two push, three pushes, and reversing into the new month at the major round numbers, coming down to the 50% level of that 500 pip box and continuing into the new month. The gray lines are the weekly separators. So again, we can look at 3 weeks, 1 week, 2 weeks, 3 weeks, end of the month, 3 levels of rise. You can break all of these down into smaller and smaller components to have your thesis each week, each day, and each session. Some of you may be familiar with Jim Simons. Again, you can go Google him or read his book, The Man Who Solved the Markets. The magic behind Jim Simons' trading strategies consists of collecting an enormous amount of data and analyzing the data to find statistical patterns and non-random events in wide-ranging markets. The Medallion Fund made an average of 66% a year. That there were, as far as I'm aware, the largest hedge fund in the world, larger than Bridgewater, in terms of their returns. But again, great video interview with Jim Simons. I would highly recommend going and watching that. Just coming back to the basic concepts, that when we talk about fractal, another state of pure randomness is called white noise. So as many of you know, and say some people don't like the 1 minute, they want to know what the analysis is on the 5 minute or the 15 minute or the hourly. But the levels and the behavior of price based on those time of day levels of rise and fall based on the bigger fractal pattern. Do we have a down month, a down week, a down session? So just in simple terms, if we have a breakout of a month and the new month begins, there's our high bull. And again, people ask, well, I've heard that term before, and well, go read John Carter's book, The High Bull, The Low Bear. But point being, new month, the market has consolidated up high after 3 levels of rise, gone into consolidation underneath of the high bull, inside. So if we talk, again, on the matrix idea, everything's in a box, we come back and we look at the previous month's low. The market broke out of the box, came back inside, came back underneath of the high of the box, and broke back down inside of the new month, new timing, new month. We're back inside of the box, up high. Our thesis could be now that we may be looking for shorts back to the bottom of the box. So when we take into consideration the consolidations, down low, up high, what time? Is it a daily? Is it a session scalp? Is it a daily scalp or trade? Is it a weekly trade? Is it a high or low of the month opportunity? Then understanding timings. So, for example, the average trading month has 20 trading days. We're in June right now. It has 22 days. 10 days in a normal situation, 11 this month, is 50% of the time in that month. So what that means is that at 50% of time and price, we may have a change or a continuation level for that market direction. You can count 10 days and you'll see where there may be a change in direction, a high bull in the first week. The market changes at 50% of time and reverses back down to the low of the month. So just pausing for a second and understanding, you can back everything up and build your thesis each week and each day on a particular instrument. If you have multiple instruments, you can still go back. Everything starts at the big picture for me because I want the odds to be skewed as heavily in my advantage as possible. So understanding that people focus on just price, but I've mentioned this over and over again, time of day, but the timing of everything is critical. We have 3 weeks. We can have 3 weeks of rise. We can have 3 months of rise. Those levels, when they coincide with a daily setup, a 3-session Asia, London, New York, 3 levels of rise on a 3rd week at the high of the month, could potentially be a 700 pip trade. We saw a 400 pip trade on Friday on gold, low of the month to high of the month. There are 3-day cycles within these setups. I've talked about this on the major pairs. So we can count 3 days. Again, we'll just stick with the euro. When does the count begin? For me, it begins on the 1st day of the month. So people have said, okay, I'm confused. You talk about you can get a day 2 setup on Monday, which you call day 1. Monday's the 1st day of the week. The 1st day of the month is the 1st day of the month. That's day 1. I start my count on the 1st day of the month in a new monthly cycle. So if I have a high bull, and again, this is not cherry picking the euro. You can apply this on any instrument. I'm just using one example. I want you to go and do your own homework so that you can use this information to put yourself in the best possible trade opportunities. So I count day 1. I'll blow this up. The dotted line is the 1st day of the month, day 1, day 2, day 3. Now, this is why it can coincide with the days of the week, because if we put those on here, the gray line is our Friday. So if we have our high bull, the dotted black line is our Monday, our 1st day of the month. We have day 1, day 2, day 3 on a Friday. First red day after a large bull candle and trap volume up high potentially may offer us a trade on the Monday. We then count, so again, 1, 2, 3, 1, 2, 3. And that gives us a high of the month, high of the week, high of the day, potentially may have been a high of Asia, London, New York trade opportunity, possibly right at the high. 3-day cycles on the major pairs. I've talked about first red day, 3 sessions of rise for a sell high opportunity. These are the types of opportunities when you coincide the timing of everything algorithmically with fractal levels of where you can identify the possible levels for best trade setups. So just coming back to the point of all of this is, although the markets can be complex, a simple duplicatable process each week can be done and performed by a retail trader. So again, separating myself from chasing moves every session with the blue pill, looking at things from the big picture and seeing the inside of all of that as the matrix and looking for the best trade setups. So again, 3 weeks, 3-day cycle setups, major pairs, first red day, 3-day setups for trend trades, reversals, or trading ranges. 3 levels within that. We can have 3 session trades. So 3-day cycles, 3 session trades that will lead into executing the 3-day setup. So I talk about letting the day evolve, because if you take the trade in Asia, unless we are at the high or low of the day in that box with a trade setup, the day has not evolved yet. We might have a scalp in that session, but the larger, bigger trade, the larger, bigger fractal trade may occur in the US. And we'll talk about performance-related stuff in a second. So 3 hours, 3 levels of rise and fall. So again, this all breaks down. Why 3? I don't know. But that's what things break down into. Maybe that's, again, the grand organized design within fractals, mathematic, computer-generated fractals that may be being executed by HFTs, algos, etc., are only executing what is human buying and selling behavior that all breaks down again mathematically into fractal behavior. One of the things that drives these monthly, quarterly, and weekly cycles is the economic calendar. Why? Because every month the same calendar comes out, and quarterly there are announcements that are executed on a regular basis as well. Now, somebody made a comment a few weeks ago, oh yeah, the market reacted to the news. No, the market doesn't react to the news. They already know the news. They use the news as a tool to clean the board off, to wipe the board. If they were allowed to just move the market violently as far and as often as they wanted, nobody would trade it. And so we have rules that are somewhat in place behind the scenes, the World Economic Board, Monetary Fund, they regulate to some degree. The banking system regulates this, because otherwise people wouldn't trade the markets. The world economy would be completely unstable. And so we have, again, average monthly ranges, average weekly ranges, and average daily range. So you'll notice in a lot of cases that even when we get violent moves within a day or a week, by the end of that week or within a few days, it returns magically back to a very similar level within a certain range of where that all started from. So breaking all of that down, that allows you to then identify what your best trading setups are. So people keep saying to me, can you send me your playbook? Can you show me what your best trading setups are? I'm not hiding anything. I've shared everything on here. It's in the videos, it's in the notes, first red day. We've had, all the other 3 levels, the pump and dumps, it's all in here. Now, what is critical here is to only trade your best trading setups. So we'll talk about a couple of things that interfere with that in a moment, but know what they are. So when you know what they are, you're not going to the screen with the urge to trade. You're going to the screen with an understanding that you are looking or hunting a best trade setup. It may be just for that session. It may be over the course of 2 or 3 days. It may be over the course of the day with 3 sessions. You may be in Europe and you're trading London, but you're looking for a US, Asia, London setup, a 3-session setup into the Open of London. You might be in the Northern Hemisphere trading the New York session, and you have the opportunity on a lot of cases to trade some of the larger moves maybe at the end of the US session, because you've got Asia, London, New York, and daily levels. You may be in the Southern Hemisphere and trading Asia after a London US session into the Asia Open session for a 3-session trade. So these are all the things that can go into building your playbook for best trade setups, because we're all in different parts of the world. There are certain traders that are only going to want to trade certain time frames. They're only going to want to trade certain types of setups just based on their makeup in terms of risk and availability at the screen, all of those things. But What are your best trade setups? Why is it a best trade setup? So again, we talked recently again about making you have to have edge. It's not a matter of catching moves. It's a matter of knowing that you have the duplication within this larger complex fractal that breaks down into the smaller fractal that can be reproduced. It's about simplicity and duplication. So again, going back to that first part, the golden ratio, pi, Elliott wave, indicators, stochastics, all of those things, commodity channel index. People talk to me about looking at crossing pairs for identifying the best trades, and you name it. But see, all that makes it more complex. And again, that you're adding in variables that will cause analysis paralysis. The simpler you make this, the more consistent you'll become. So, why is it a best trade setup? How will it set up? So, well, obviously, if it's a 3-session setup, I'm looking for maybe Asia to make a high, London to make a low. There's my box, and I'm looking for a trade in the U.S. off the 50% level of that high-low. Or maybe it's going to be a sell high, Asia, London, New York, into the New York Open for 3 levels of drop. Whatever that may be, how will I look and easily identify if the day itself or the session itself has set up for a best trade setup? So recently I talked about the matrix box, 3 levels of rise. We had that this morning on gold. The market went up 100 pips, locked in the high. It held volume in between 75 and double zeros, broke down, and in the first 30 minutes of the 12 candle Asian window gave a lower double top inside of the high at 50 for a vertical 50 pip move, which continued because we were at the high of the month, high of the week, high of the day, back through eating into traders that were in the 400 pip move long from Friday's New York session. So how will they set up? 3 sessions, 3 days, 3 hours, 3 weeks, whatever that may be. You could be trading end of day, but this is still critical when you know that the timing, middle of the month, end of the month, could be opportune times for best trade setups on a daily chart, whether it's a trend, whether it's a reversal. How will they set up? Where will they set up? Will it be at the high, the low, inside of the high, inside of the low, in a larger box? Will it be at the high of the month, the high of the week? Where will your best trade setups be? Will it be off 50% if it's a trend trade? When might they show up? Day 1, day 2, day 3? Can you get a level 3 trade on day 1? Absolutely. We had it this morning on gold. Can you get a day 2 trade on Monday? Absolutely. Why is that? Because the move might have started on Thursday, Friday, Monday, into Tuesday for the trade. These are all the little things, again, that, whether you code them or approach them the same way, but remember, going back to the bigger picture, the fractal, the 3 weeks, the 3 days, we can have a 3-day setup, but it might be on a Tuesday because of when the month starts, day 1, day 2, day 3. Now, not everybody's going to want to agree with this, but simplicity, if you can count to 3, that's basically the golden rule. If you can count to 3, you can identify some great trade opportunities. How will you trade them? What will your size be? So again, I talked about session scalps versus sizable, scalable trade setups, high of the week, low of the week, high of the month, low of the month, that sort of opportunity. And it depends, because some opportunities are going to be based around news, or the volatility may be too great, still tradable, but you may not size in as much because the market conditions are different. Those are all based on how that day, that session, that trade will set up. How long should it take? Coming back to how will you trade them? Size, risk, take profit. What is your entry going to be? Where will your stop go? Where will your take profit be? How long should the trade take? So these are the factors that stop traders from having consistency. Great feedback this morning. Trader saw the trade in Asia on gold, did not take it. They did not feel comfortable trading in Asia. And as I reiterated, high of the week, high of the month, high of the day, the upper level, 3 levels of rise, trap volume, but you need to really understand the psychology behind your trade setups. they broke on a gap the high of the month. That has other time frame traders now triggered into the market, 4 hour, 1 hour, maybe 15-minute, 5-minute breakout traders, daily, all those, maybe even weekly and monthly. Maybe there's systems that are triggering breakouts. But understand, once they're in, they may be trapped now for the rest of the month. They could go down now for the rest of the month. They could be. I don't know what they're going to do. But there's volume now caught up high. And as you've heard me say before in previous videos, when the market closes a day with volume trapped outside of the previous day's higher low, that's the beginning of a new count for me, day one, because now we could be going for 3 days in the opposite direction. Day 1, day 2, day 3. So how long should, if you're in just a session trade, how long should it take? How should it behave? So I talk about getting in on the consolidation, and when that consolidation is there and I enter, I'm expecting it to accelerate right away within 15 minutes, which comes back to time compression, because the way that that's set up, it should move aggressively because they have traders trapped. And that 3-level move should go quickly, straight through for 50 pips, because they have volume trapped on those levels in order flow on the opposite side of their positions. And the name of the game is to shift the money from the many to the few. Where is the money? So how should it behave? What will you do once you are in the trade? What will you do? Are you going to go to break even right away and then get stopped out at break even? Are you going to manage the trade knowing that your stop is in place, you've accepted that you could lose on that trade, and you're going to let the trade now evolve and trade out? Are you going to get scared out by the price moving back and forth and the spread flashing and the impulsive move back into your position, even though it doesn't go against you, it hits your entry fill price, looks like it's going to explode? These are all part of the manipulation tactics of the smart money on the other side of that screen. Scare you out of a winning trade. So how will you behave? How should price behave? So what will you do once you're in the trade? How are you going to manage it? How will you manage yourself before, during, and after the trade? You kill the market. You smash it out of the park. What are you going to do next? You going to take some more trades? You going to keep trading? Because now you just crushed it. You're the man or the woman, and you're going to take some more trades. Now, I take the trade, I lock it in, and if I'm done because that's the only trade, or there might be if that's the U.S. session and that's first hour, I might have a New York Open trade. But once I'm done, I'm done. And the reason why is because once I lock it in my account, I don't want to give it back. And I know there's traders that will trade the whole session, the whole day. That's their choice. That's part of their model. If it's working for them and that's what produces their profitability consistently, that's their choice. My objective is to have scalable trade setups that I go to the screen, I execute, and I get off the screen. I go to work, I work for that hour, I'm done. That's my approach. So how will you manage yourself before, during, and after the trade? Your emotions, your impulses, and your mindset. What is your objective? What is your trading plan defined for you? So again, coming back to some things I talked about with traders talking about back testing and your P&L and their stats and all that, it means nothing if you don't have a process to manage these things. Because you can, again, take random trades, impulsive trades, you get stopped out, but you want to get back to the high water mark, so you take some more trades trying to get it back. You actually make it back, and then you blow it up later. These are the erratic behaviors that cause most retail traders to lose consistently over and over and over again. They have not defined the real parameters that will affect their consistency. So you need to identify all of these things. So what is the routine that do you have that will actually ensure that you take your best trade setups? And the meaning behind that is this. Is your process simple and duplicatable enough so that you actually take the trades? Why would you miss trades? So FOMO, there's a difference between missing a trade because it's not part of your trading time. It's happened outside of your trading time. The market's made a big move. You've heard me say this before. There's a big move. I don't have the perception that I missed a trade. The market is moving all the time. It moves outside of my trading window. I haven't missed a thing. I need to go to the screen and identify whether or not I have a best trading setup opportunity when my trading time is there in that trading window on the instruments that I look at. That's it. That's all I have to do. I didn't miss anything. But if you're missing trades during your trading window that were part of your best trading setups and you did not execute them, or you didn't size them accordingly, or you weren't, again, didn't plan, didn't prepare, or didn't execute properly, how will you improve? And I talk about having an actionable review process. The whole point of the first word of that is actionable. So we talked about the live performance journal before. Screenshotting charts and saying this is where I should have got in, or I could have got in here, and I'll this is where I want to get in, and this is where I want to get out. This is where I'll place my stop. That's one side of the equation. But the live performance side of it is you. Going back to how are you going to manage yourself? How are you going to behave once you're in the trade? It's one thing at 0.01 lot, but what if you're trading 10 lots, 10 standard lots? You know, what if you're trading $10 a pip US or $1,000 a pip US? Can you manage yourself and the trade the same? That will only come from developing unconscious competence through repetition over and over and over again, and gradually growing that through consistency in your process and in your results, in your profitability, and in your consistency of only hitting the best trade setups. So how will you improve? So I'm not going to hit every trade. I understand that. There's going to be days when you're at the screen. This is really important. You're going to have a best trading setup during a session that you're trading, and you don't feel like you're in the right mental space. You might be tired. You might have already had some really good trades. You just maybe don't feel like trading. And that's okay. There's nothing wrong with that. There is nothing wrong with that. You don't have to trade all the time. So these are all the things that you need to gel with and be okay with. You're not always going to be at your best. Okay, well, if you recognize that, Friday night here in the Southern Hemisphere, Friday night, especially when we get into daylight savings, we're talking 10:30 p.m. for me when New York opens. I will trade maybe once or twice in the week, if that, at night in the U.S. session, because I'm useless at night. I don't want to stay up that late. Sometimes maybe I'm out. It doesn't matter. But I'm also not in the mood to trade when I'm fatigued, when I can possibly make a mistake and maybe the market isn't even set up right. Maybe it's a low volatility day or a low probability day. You have to be able to recognize and observe yourself from outside and talk to yourself and understand when you shouldn't be at the screen. These are all the things that the hats you have to wear when you're trading by yourself. You are a lone wolf or wolf-ess. And if you're working in a prop firm or in a trading firm, you've got a risk manager, you've got set hours, you've got an office manager, a performance coach, you've got other traders to liaise with, maybe particularly in your specific instruments or in your sector. But otherwise, you either have to take charge of all those hats and have systems in place, processes in place to be a consistent high performer, or you run the risk on the wrong day, in the wrong headspace, on the wrong setup, with the wrong leverage, at the wrong time, potentially blowing your account out. So hopefully you got value from today's video, traders. I've learned a lot of these lessons the hard way, and only through an actionable review process on myself and on my process and on my edge or lack of edge have I been able to consistently get 1% better every single day. Have a great week. It's Monday. We've already started the week off with some decent moves. We're going to have volatility and great trade setups this week. Hopefully it's your best week ever. May the markets go with you.